UnSILOed podcast is produced by University FM, elevating the stories of your institution.
Welcome to UnSILOed. This is Greg LeBlanc, and I'm here today with Scott Patterson, who is a journalist with the Wall Street Journal and also the author of a couple books in the area of finance. Most recently, this book called Chaos Kings, How Wall Street Traders Make Billions in the New Age of Crisis. Also a couple other books from about a decade ago, I guess it was, including this one called Dark Pools, High-Speed Traders, AI Bandits, and the Threat to the Global Financial System. And then before that, you had this one called The Quants, How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It. Welcome, Scott.
Hey, Greg. Thanks for having me.
Well, look, all these books, I think they have some commonalities. Obviously, they're all in the world of finance and trading, but I think they also kind of tell a story of some kind of outsider, right, who comes in and disrupts the system and oftentimes does things that, I'm going to say from an academic perspective, the academics sometimes find a little puzzling. Sometimes the academics are sort of at the heart of things. In the most recent book, the Chaos Kings, you highlight Nassim Taleb, right, and Spitznagel and Sornett and a couple other folks who are, I guess, challenging modern portfolio theory and efficient markets in separate ways. And of course, on the cover you have the black swan, right? And I remember during the Corona crisis, I was asked by a number of portfolio managers to give talks on black swans, and it's everyone loves this term now. It's kind of used to describe anything that seems kind of out of the ordinary, but I think it's being used so often that the unpredictable is now predictable. So I guess the first question is, what drew you to these characters, who I think, even though they began as outsiders, I think they're still kind of outsiders. I don't think that they are considered sort of mainstream, certainly not by financial academics.
No, I think that, maybe it depends on who you talk to, I guess, but within the world of Wall Street or academia, which I'm not as close to, I think Nassim is still seen as an outsider. Many of his ideas have been adopted to an extent, but he's iconoclastic. He's a bomb thrower. People maybe just don't like his personality, and that reflects on people's willingness to accept the ideas. There's also this tendency to say he's never really said anything new. That it's all just it's all this stuff has been out there in various forms, which is and I touch on that in the book. It's true to an extent, but what I found in my research through all these books and back when I wrote the Quants, I knew Nassim and talked to him, and he was influential in my take on Wall Street back then. Is that there's while he's talking about these fat-tailed events that sort of live outside the normal the bell curve, normal expectations of what should happen, and why academics or traders or both, because they kind of went together in the 80s and 90s, and that's the Quants is sort of about that phenomenon. They still resist incorporating the fat tails into their daily lives or into their models, and that affects how they trade. So Nassim is just sort of pounding the table saying, I've seen the models. He taught an NYU course on it, and you guys are not accepting reality, that there are major events that happen that will scramble your strategies and you'll lose everything if you continue to operate the way you are. And we've seen that happen time and time again.
Yeah, I mean, some people might portray this as kind of the quants versus the anti-quants, but I think that would be kind of a fake history, right? I mean, these guys are deeply quantitative. I think it's really, one type of quantitative approach versus another type of quantitative approach where the latter emphasizes insights taken from the field of complexity, right?
Yeah, a big influence on Nassim was Benoit Mandelbrot, one of the fathers of chaos theory, and he had been researching these extreme moves in financial markets for decades and decades. I think he first started looking at cotton markets over many years, and for Mandelbrot, this is another scene I recount in Chaos Kings, is when Nassim first met Mandelbrot after Mandelbrot gave a speech in New York. Nassim said, "Why are you doing this? You're this great thinker. Why do you care about financial markets?" And Mandelbrot said, "Data, reams and reams of data." So for him, it wasn't really exercise in trying to figure out trading strategies. It was looking at these weird patterns that were chaotic. My book is Chaos Kings. You can't fit these things into normal markets. I think Mandelbrot liked to use the word wild, that these are wild markets. And that was a big influence on Nassim, and the Black Swan is actually dedicated to Mandelbrot. So, yes, very, very quantitative oriented. Mandelbrot was a mathematician and extremely smart mathematician. So is Nassim. But they came at things from a different perspective than most people in academia that were really just following the mainstream theories of efficient markets and modern portfolio theory.
Well, in academia we have some tension between kind of the theorists and the empiricists, and it seems like there's a little bit of that in your story, right? Where there are people that have models, and they seem to be wedded to their models, and others that are all about just pattern recognition and just looking to see what's happening right in the markets, and I think that's a theme that shows up in all of the books to some degree, right?
Yeah, that's a good distinction. I don't know if I'd thought of it that way, but it makes sense. You would think that a theorist who goes to Wall Street would quickly learn their lesson, and I think there's a famous anecdote about Fisher Black, who you probably remember this better than me, but it's something about how markets appear much more efficient from the Charles River than they do on the Hudson River. And he famously he taught at MIT, and he was a very rigid theoretician about efficient markets. But then in the 80s, he joined Goldman Sachs and started watching how traders operated, and became much more of an empiricist, I think. So that's one good example of how those barriers can break down. But I also, Nassim one time showed me an email that he had gotten from a very well-known, respected academic in finance, who conceded to Nassim that yes, we know that these fat tails exist, but our models don't work if we incorporate them into the models. And that's the problem, is that it just kind of, if you recognize that there is potentials for 3, 4, 5 sigma events, then things just aren't going to work the way that you want them to. So he basically was just saying it's inconvenient to put a fat tail into the model, and that's fine, but as long as the people running trading desks and executives understand that if you have a value at risk model, it's not really capturing the real risk that you're going to be facing, because it carves out a 5%, generally how they use 5% of the volatility, of the extreme volatility over a year. And Nassim's point, as I try to get across in the book, is that's really what you need to focus on if you want to survive, is that 5%. Don't cut it out. Make that the thing that you really care about. The rest will take care of itself.
Yeah, I mean, I think a lot of the story here, which is sort of beneath the surface, also is sort of the incentives that asset managers face, right?
Oh
Which
yeah.
has to do
Hmm.
with kind of your day-to-day returns. So, in the earlier books where you talk, in dark pools, you talk about these traders that are, they're realizing their profits more or less, by 4 p.m. every day, right? And
Yeah.
and they're in and out of the markets, super quickly. But the insights that Taleb and his colleagues, come to is that, and I think this is an analogy that we use all the time, right? You can be picking up your nickels in front of the steamroller, right? But the steamroller is going to get you at some point. But if
Hmm.
if you have to report your P&L on a daily basis, if you're giving away nickels on a daily basis, which is what the that's basically the strategy, right? That
Yeah.
these funds are employing. That's one where you're going to find it difficult to raise money. One would think because people would say, "Hey, what have you done for me lately?"
Oh, absolutely. And that's why they had a lot of trouble launching the Universa hedge fund. That was the successor to Empirica, which Nassim launched with Mark Spitznagel in 1999. They shut that down 5 years later, and then Mark relaunches Universa in 2007. And I tell a story about how they traveled the country, meeting after meeting, and no one wanted to give any money to this hedge fund, even in 2007 when it was looking pretty shaky in the markets. People still didn't understand the nature of the strategy and the benefit that they could get from it, because as you say, it just fits out it's outside the normal parameter of how traditional Wall Street strategies work, which are more geared towards short-term gains, either weekly, monthly, or annually. The annual bonus is every trader on Wall Street knows what that's all about. That's the whole ball game, apparently, is the year-end bonus more than your
Mhm.
salary. So if you show up to your boss with you're in the red for the year, no bonus. So that's why it's one of the reasons why the strategy is actually successful, because they have very few competitors. There are some other funds out there that do this, but uh, as far as I'm aware, they're the only one that does it. They only do that strategy, the
Mhm.
tail hedge strategy, and they're by doing that they're very good at it. But it's just not something that most people who go to Wall Street want to do.
Well, I mean, it's ultimately a triumphal story, right? Because I mean, they do wind up successful and appreciated by the end of the book. But I think
Yeah.
it's really more somewhat a story of better marketing, right? Because people began to see this strategy in a different way, right? Began to see it more like an insurance product. But we had portfolio insurance. Some of my colleagues here at Berkeley, right, came up with this product
Yeah,
back
right.
in the 80s, and
I think that's in the
yeah,
Quants, as I tell that story.
yeah, and so of course, it led to the 1987 crash, and then it sort of went out of favor. So I mean, what was I mean, would this strategy have succeeded in the marketplace if it weren't for Taleb's role as the kind of marketer or like the pitch man for this whole idea?
It's a good question. I think so, because of the success of the strategy. As I said, they didn't get any. Got very few takers in 2007. Some started to sign up in 2008, and then they made $1 billion at the end of 2008, and that, which is something I wrote about in the Wall Street Journal. Um, that got a lot of attention, and people started seeing that this could be value. Um, it ebbs and flows. So they had a big rush of investors after 2008, and then it kind of, depending on how much worry there was in the market, the investors would go in and out. Um, so really up to 2020, they didn't have a deep portfolio of investors. They were, another interesting story about how, traditional finance finds it difficult to stomach the strategy. I tell the story about how CalPERS decided to invest in Universa in tail hedge strategies in general, and started around 2016. And they started talking to Universa. They decided to allocate significant assets to it. They'd gotten up to around 5 billion by late 2019, early 2020. And we're even thinking of getting bigger, much bigger, maybe 20, 25 billion. But a new manager came on board at CalPERS, and in 2019 made the decision to exit the strategy. So in early 2020, Universa was forced essentially to liquidate the entire CalPERS tail hedge, basically weeks before one of the greatest crashes that we've ever seen. And that's just because this new manager, he looked at the expense and just saw it as many do, as a line item. Why am I paying 80 million a year or 100 million a year, or whatever it cost, for nothing? I'm getting nothing out of this. And others who supported it said, actually, one day you will be very happy that you we're paying for this, and it'll pay off much more than what you put in. And there are other reasons for that, why CalPERS wanted to do that, because they were struggling to get returns that can meet the pensioners' demands over the years. They had a shortfall, expected shortfall, and they wanted to have a strategy that allowed them to get more upside from the stock market, because when traditional pension fund strategy is sort of vanilla strategy is 60-40, 60% in stocks, 40% in bonds. The Universa pitch is, you're giving up a lot of upside from stocks if you do that. Why don't you get a real hedge, only allocate around 3% to that, and put the rest in stocks or something else that's got more upside. And if you do that, then your returns over the years will be better. At least historically, that's proven to be true. So CalPERS was interested in trying to do that, but then unfortunately they bailed on the strategy just when it would have paid off.
Yeah, no, I love that story. I mean, I'm here in California. I'm familiar with a lot of these folks. I know a lot of these people, and but the idea is really powerful, right? And the idea is that a 97% exposure to equities with a 3% essentially downside protection can outperform a 60-40 portfolio, and in part because what we're seeing in many cases is that stocks and bonds are correlated, particularly in downturns,
especially
so
recently,
we don't get the protection that we thought we were getting, right?
Yeah.
The other thing,
and with a fast-moving crash, you can really, when as they say, correlations go to 1, you can really get stuck, and that's what happened to a lot of pension funds in 2008. Was that in order to, get liquidity, they had to sell their stock portfolio, and a lot of them sold their stocks. CalPERS, I think, is famously did this at the bottom, whereas a strategy like the Universa strategy is you'd be able to hold on to your stocks, maybe even buy at the bottom, because you're getting this big infusion of cash just when you need it.
Yeah, and I think the key insight is that if you were to go back and delete like the 5 worst days in the stock market, like over the last 30, 40 years, you would dramatically increase your overall return. But similarly, right, if you were to delete the best 5 days, you would dramatically decrease your returns. So, the idea would be to get rid of the downside risk without getting rid of the upside potential. But it seems like some of these strategies, if we believe that the probability at the end of the distribution is actually higher than, say, a normal distribution, then we should be able to make money regardless of whether, I mean, if people are underestimating the likelihood of both high and low extremes, then we should just be able to buy volatility, right?
I think that it's tricky. I think, and it's also getting outside of my area of expertise. I mean, I talk to Universal a lot. What they would say is this is not a strategy that's as easy as it looks. Maybe that, and this is why a lot of competitors get in and they put on the strategy for a couple of years, but end up shutting down. I don't have the universe's secret sauce, and like I've talked to other managers who have analyzed this risk, like people at AQR, who are sort of notoriously bearish on tail hedging strategies, and they look at it and they just say it's too expensive, basically, to buy what they call lottery tickets. You're going to lose money over time. Now, if you sort of dig a little bit into the details, what they are looking at is not remotely close to a universal strategy, because they're looking at options that will pay off in, I think, like a 5% move or a 10% move. Which
not
are
these
more,
deep
a
out
lot more
out of the
expensive.
money options. So Universe is
Yeah.
going for the deep out of the money options.
Universe is buying stuff that's typically viewed as junk. Like,
Yeah.
it's the ultimate value play, because these things are almost always going to expire worthless, because it's a bet on a 20% decline in the S&P 500 within a month, which never happens. Now the trick is that you don't really need to get a 20% decline for those options values to surge dramatically. If if the VIX suddenly shoots up 20 or 30%, all you need is the fear of a super big crash to cause them to be valuable, and then Universal can cash in that trade. But there's things that they do that I think partly because they're one of the only counterparties in the market for these kind of options. They're able to use that market power to get better prices. So they're in a way kind of like a market maker. Other hedge funds or bank desks, they see that as easy money. You just sell these things. Selling volatility can be very easy money. You just sell it. You get in a couple $1 million or whatever it is, steady money every month. You think there's really no risk there, and you're happy. And Universe is happy to take that trade, and just kind of laughing because they know that it's, at the end of the day, this is not going to work out well for their counterparties.
Well, I mean, I think you can see why, say, CalPERS is going to find it more difficult to adopt this strategy than, say, a non-public pension fund, because all of their performance is under public scrutiny, right? And all of the conversations that they have, right, with the fund managers are subject to public scrutiny. And so you could just imagine, right, the beneficiaries, looking at this line item, year in, year out, and saying, hey, what are we doing here, right? And the payoff is presumably going to happen after the fund managers have all moved on to other jobs.
Right. Yeah, I think that's part of the short term. The short termism is a drawback for those managers. I mean, they should be thinking about what's the best for their fiduciaries, for their, pensioners. But that, we know that's not the world we live in. And I mean, CalPERS, it's kind of surprising that they were the ones who did, went big on this, because they are so big. You would have to have a gigantic tail hedge to really move the needle. And that was one of the criticisms of the new manager, was it's just, you can't scale it to really move the needle for us. Now, I don't know. I mean, 25 billion, that probably would have moved the needle. in a big crash. But I think it probably would make more sense for a smaller pension fund where the scaling was more realistic. And it's one of the big questions about this strategy in general is it scalable to the broader market? Because Spitznagel will say that my strategy is the best one. It works better. Let's compare it to everything else. And yet nobody takes him up on it because it's, for one, it's so hard to implement. And there's also just questions of how big can you get buying exotic 20% out of the money options.
Yeah, presumably you'd arbitrage away this mispricing of risk at some point, right? If enough people do it.
Theoretically, yeah, you would. And it's one of the mysteries is if it is so effective, how come it hasn't been arbitraged? And I think they would say, well, there's all of these structural impediments and behavioral impediments to people adopting the strategy, and that's their alpha, I guess you would say, is they're able to do it.
Well, I mean, so I teach a course on behavioral finance, and I think there's two things at work here. I mean, one is this kind of systemic underestimation of tail risk, but the other, it could be simply recency bias, right? In the sense that, I think that Spitznagel and Taleb would not say that they're making a directional bet, but in some sense it could be seen as a directional bet because this strategy has performed well in a period where we've had the Fed doing everything they can to kind of, dampen down risk, right? And so that's really a unique environment, right? So, we talk a lot about the value at risk model and how the value at risk model, in calm times, systemically, right, underestimates risk. And that's been sort of what's happening over the last couple decades. But if it's recency bias, then we would expect that people would overestimate risk, in the wake of these big events, right? So after the global financial crisis, after, say, maybe a flash crash, after, the coronavirus pandemic, then it might make sense to do the opposite. So do they think of themselves, do they think of this as being sort of a strategy which takes advantage of the unique policy situation that we've been going through the last couple decades?
Yeah, definitely. I mean, they're, the biggest Fed skeptics I've ever met are among them, outside of the gold people that I used to write about. I mean, their argument is that they're just, building dry tinder for massive blowups. And, the 2008 was an example of that. The Fed came in and, they would say, well, 2008 was the result of years and years ago, Alan Greenspan, with the Greenspan put, building up risk that manifested itself in the financial system and the housing market. But then, they came in with this zero interest rate policy and then, buying bonds, everything they could do to keep volatility low, to dampen volatility low and increase risk appetite. So they were theoretically forcing people into risky assets. That's a strategy for doom, and their perspective is that you're not really weeding out the root of the problem. You're just letting it, grow like a cancer, and it's just you're giving the patient morphine, but the cancer's still there. And it's eventually the patient's going to die. I don't personally agree with their argument there, but it is. I mean, in the fullness of time, we'll all find out. Where is this just leading to some Armageddon like explosion of debt, which they foresee.
But what's fascinating is that a lot of the protagonists in your books, they have these policy prescriptions, which, if they were implemented, would more or less put them out of business, right? So you saw the same thing with
Yeah.
with Levine, right? In dark pools, right? He was taking advantage of these structural problems with the Nasdaq, but he kept advocating that these structural problems, be eliminated, right? And if they were eliminated, then what's his role, right? Then he no longer can kind of exploit these anomalies and loopholes.
Yeah, and Josh Levine I think he would be perfectly happy to see his ability to take advantage of the system go away because he's a unique person who doesn't really care. Now, the guys at Daytech and the traders who are using his software, they would be very upset if the policymakers adopted his proposals, which are, I think, still, who knows if they would really work. I mean, he's talking, what he wanted to do is do like sub penny trading, and that would eliminate a lot of the ability of traders like the day traders at Daytech and elsewhere to take advantage of these big spreads. The spreads would just collapse. But he was, this was before the age of the high frequency trader, which HFT came out of Island, which he created. So who really knows? Sub penny trading could have just resulted in just a lot more trading, where people are arbitraging micro pennies at high speeds.
Now, one of the other stories within the story of Chaos Kings is this kind of back and forth between DDA Sornet and Nassim Taleb over the predictability, right, of crashes. And in this sense, I mean, Taleb is sort of on the side of the efficient market folks, right, saying that you can't really make any money by predicting what's going to happen. Whereas Sornet has this belief that there are these signals or indicators that can tell you, hey, you're in a bubble, and so in that sense, Taleb, it's almost like he's siding with Greenspan, who famously said that you don't know whether you're in a bubble until after it's over.
First, yeah. Right. Yeah, it is. It is one of the ironies is that in the big debate about portfolio theory, they do fall on that efficient market side of things to an extent. I mean, their strategy is taking advantage of some structural, issues, and the way that Wall Street generally underprices risk.
But Taleb's saying you can't time things, right?
You
just
can't
have
time
to have
it.
this. Yeah, if you have this insurance policy, it will sooner or later pay off, but you can't tell when.
Yeah, right. So they are sort of making a directional bet, but they can't time it, which I think is probably true. And Sornet's insights are really interesting. That he's saying, yes, the market generally is very efficient on day-to-day basis, but there's times when it sort of becomes dislocated from fundamentals, and it just gets really out of whack. And there are signals that you can detect that are telling you when this is happening, and when it's really going like what he would say super critical or super exponential, which is just the moment before a blow up, and then you can trade on it, buy a bunch of put options, and he's done experiments over time, and I've looked at some of them, not all of them, but what they seem to show is that his system does have the ability to recognize when assets enter a bubble territory, but timing the bursting of the bubbles seems very hard. And he made some predictions about a decade ago with various commodities and markets, and what was happening was his predictions did show that these things were in bubbles, and they went down a little bit, but then we go up a lot more, like
Right.
30 or 40% or more after he said, this isn't a bubble, it's about to pop. So that's the thing about bubbles is really it seems extremely difficult to time the bursting of the bubble, and and that's why trading around it in the debate that Nassim and Didier have, which I recount this meeting that they had in New York City, um, where Nassim is trying to explain, what you have here is very interesting, and maybe I'd buy some put options if you showed me this, but this is not a way to manage risk. And that's a fundamentally different way of looking at it. When Didier is more like a gambler, he's trying to say, you know, this is going to let me gamble better because I've got the most sophisticated system in the world, and it's based on, physics, and I can detect when bombs are going to blow up with this stuff. Um, but it seems saying, well, fine, if you want to do that with your own money, but if you're managing client risk, this is a very bad thing to try to use to do that, because you're trying to time the market, and it's going to end badly.
But at the end of the day, I mean, Spitznagel does have to have some, right, make some timing decisions, right? So in the immediate, as soon as there's a crisis, he has to decide, do I liquidate my positions on day one, day two, day three, right? So, in the coronavirus crisis, right, if you, liquidated your position, a couple days in, you do great. But if you held on for another week or two, then, you're going to give up all those gains.
That's a really good point. And what they tell me is they have signals based on historical data that shows them when they need to, cash in. But you're right. I mean, there does have to be some kind of human element there. It's not completely robotic. But I tell the story of, 9/11 with Empirica, where they sort of learned this lesson that, they held on to their positions after 9/11, because their clients, and I remember I lived in New York at the time, everybody thought this is just the start. There could be more attacks, and who knows what's going to happen. So they held on. There were no more attacks, and the market rallied, and their positions, which should have paid off handsomely, did not. So what they learned was once you forget what you think is going to happen in the world. It looks like you have a very good return on your investment, take advantage of it. But they never like opened up the box to me and said, here's the signal and exactly what tells us when to liquidate. They say they have models that give them the signal.
Now, another theme in your story in Chaos Kings is about how Taleb lost his appetite for trading, really, and decided to lean into his status as a flaneur, right? But yeah. I mean, he took this insights around financial markets and extended them into other domains, and so he got involved in all sorts of debates around infectious diseases and genetically modified organisms and so forth, mm-hmm. right?
Yeah, I mean, you'll see it in his books. He ranges over many different subjects. Each book, I think, along the way, extends more and more outside of the realm of finance. But I think it's interesting how, you really can, at the end of the day, see how the trading strategy and put options lay behind like so many of different things that are in those books. So it's the core insight, which is very extreme things can happen way beyond what you ever expect, which happened to him in 1987 on Black Monday. He made a lot of money on that trade, and it also made him realize that all these guys around me ain't so smart. They don't have it figured out. And so that's Black Swan. Then you look at Anti-Fragile, which is something that's supposed to benefit from volatility, get stronger from volatility. Well, what gets stronger from volatility than a 20% out of the money put option? Um, so, you know, the strategies lay behind many different things. But yes, he has successfully applied it to uh, a lot of different, other realms, and it's really, his insight into pandemics, which he's been talking about for many many years. That's one of the things that sort of inspired me to do this book. Was in the first quarter of 2020, Universa posted, famously a 4,000 plus percent return on their positions, so it wasn't 4,000% on their assets under management. There's a lot of confusion about that, but so Universa did that, and then at the same time in January of 2020, Nassim and a few other colleagues wrote a paper warning about the risk of COVID-19 because it had these properties that appeared to be extremely risky. That, how fast it could spread. It was, travel is up a lot more than it used to be, so this thing might move across borders more quickly than we realize. They issued this warning that we need to take extreme measures to protect against it. Now, I remember in January 2020, I was not thinking that COVID would become a global pandemic. I was thinking, wow, China's going to have a real problem here, and maybe this could mess up some trade, issues, and that could affect the market. But I had no idea, and nor did many, even experts. WHO was not sounding the alarm at the time. So I kind of thought, wow, it's interesting that Nassim's worldview, which is based on black swans and exponential risk, allowed him to see this, gave him the tools to see what was happening, and warn about it, in real time. They actually sent their memo to the White House. I'm sure it ended up in a, trash can or a toilet or something at some point. But, people, if they'd listened, maybe, they weren't the only ones. There were some others, warning about it as well, but not many. So that's kind of what it sort of inspired the germ of the idea of the book. Was it would be interesting to tell the story of these guys, and I've known Nassim and Mark, since mid 2000s. So I just emailed them and said, hey, what do you think about doing a book? And Nassim said, no way. I mean, so he was a reluctant collaborator for a while, but he finally came on.
Yeah. Well, I mean, when I started preparing these talks for these pension funds in 2020 after the pandemic, asking about black swans, of course, I went back and I found all sorts of folks who were prophesying, right? So, a bit of hindsight bias. But I think the main point that Taleb's making about connectedness is that, we all thought, or in certainly in certain circles, there was a belief that if you took all the, mountain climbers and tied them together with a rope, then, every mountain climber would be safer, because if they fell in a crevasse, then, they'd be connected to the rest. And that was the idea behind, connecting all the markets and creating all of these different types of instruments that allowed you to, repackage risk and so forth. But what we discovered is that by tying all the mountain climbers together, it meant that if one of them fell down the crevasse, they'd drag a whole bunch of other people with them. And I think in your earlier books, that's sort of part of the story, right? About how, by creating all of this liquidity, right, and by connecting all of these markets and allowing, price movements to diffuse more quickly, it actually leads to potentially more instability, right? And ultimately, liquidity can collapse more quickly.
Yeah, I mean, I do think that the risk of high speed contagion across markets is something to we should be concerned about. I wrote about that in Dark Pools, and we haven't seen the disaster scenario that I scoped out there. The flash crash was an example of that, and I was on the desk at the Wall Street Journal that day and remember it clearly. And I called up some high-speed traders I knew and said, "Hey, what what's going on here? And they said, oh, we turned off our computers. It's too crazy for us. So yeah, I mean, I was sort of with high speed trading. I was sort of on the front lines of reporting it. It really wasn't a well known phenomenon, and I just found it very alarming. That the financial markets had evolved into this race to trade microseconds faster than the next guy. And at the time in 2010 or so, this was largely a U.S. phenomenon. Now, it was moving to Europe a little bit, but mostly it evolved in the U.S., out of Chicago, and New York, and it was moving from asset class to asset class as, the stock market by 2010 or 2011 was kind of dead for them. They'd arbitraged out all the little, inefficiencies. So they were moving to the next thing and the next thing. And, and then they started building cables across the Atlantic to Europe, and, it was moving into Asia. So I was like, oh my God, like this is some gigantic network that's going to be trading globally at high speeds across asset classes. And the way these models work is they're trading these correlations between all these different asset classes. And I thought, well, what, something could get wacky in, say the dollar or gold or oil or something, and that causes sort of a dislocation in the correlations, and you have contagion that ripples through the strategies. And if this happened at a major firm, that ripples to the other strategies that others are running. That was my first book, was the Quants, and that actually did happen to quantitative hedge funds in 2007, in August 2007. So I was kind of thinking, like, really crazy things happen with these computer strategies. I mean, who knows, an AI could run amok, but I don't think we really have seen that. I mean, in 2020, there was some extremely insane things going on in the markets. And I think probably, we had negative oil prices, bonds. You couldn't buy a treasury bond or sell a treasury bond for a while at one point. Not normal. But I think a lot of that was not just, it was an exogenous event. It was, COVID was causing the global economy to seize up. And that moved into financial markets. Central bankers came in and threw a bunch of money at it and cleaned out the pipes. This idea of a sort of a high-speed computer-driven contagion has always been something I've kind of, been concerned about, but I don't think we've really seen that yet. But,
well, now, towards the end of the book, you talk about some of the, catastrophic risks related to things like climate change, right? And maybe, asteroids and so forth. Now, I mean, some of those things, like an asteroid strike, I mean, I don't know exactly how you could, trade on that, because presumably, if the world goes extinct, then there's no way to cash in your chips. But for things like global warming, I mean, you talk about Bob Litterman, and Bob Litterman reappears earlier in the story as sort of a member of the modern portfolio tribe, right? But then towards the end of the book, he shows up as someone who is an advocate of investment strategies that exploit our maybe misunderstanding of risks like climate change.
Yeah, I think that his concern about climate change is a function of his expertise as a risk manager at Goldman Sachs. And when he started looking at it after he left Goldman in around 2010 or so, he kind of got freaked out, apparently, and was realizing that the models that were being used to assess risk from climate change were just wildly off. and not reflecting the real risks that we're facing. So he's become an activist basically. I mean, if you read a presentation that Bob Litterman gave to say Congress, in the past few years, you might think you're reading a diatribe by Greta Thunberg. It's literally like we're in real deep shit here, and we got to do something right now because the longer we wait, the more the risk manifests, and the more we'll have to do to
Right.
head it off. He's a sort of a traditional economist, so he's like any economist who looks at climate change and managing the risks to say let's just throw a carbon tax on it, you know, uh, and that's gonna help it a lot. I don't know, I mean maybe it's not politically realistic. That's the problem with that. Maybe one of these days. But anyway, I mean, to me, the more interesting thing is you've got this guy. He's very, he's a Republican, very conservative individual. Comes out of Goldman Sachs, and yet here he is saying we have an existential risk we're facing.
Yeah.
And he's not. I mean, J.P. Morgan has said the same thing. And I mean, climate change is what I write about at the Journal. That's my beat. So I wanted the book to be, not just about buying far out of the money options to protect your portfolio. I wanted to be broader in terms of thinking about the risks that we face, and that's the subtitle of the book. The new age of crisis, which I try to make an argument that we're entering a world of crises are sort of manifesting and overlapping more and sort of magnifying the nature of the crisis. Some people call us the poly crisis, and climate I
Yeah.
think is the big dog in that that crisis world.
But again, it's kind of hard to design an investment strategy around that, right? Because what you really would be betting on is not, right, the trends in climate as much as trends in people's response to climate, right? So, if you think
Yeah.
that people underestimate the probability of a bad outcome, right? You're going to bet one way if you think they're going to continue to underestimate. You're going to bet a very different way if you think that they will sort of wake up to it, right? And realize, and more accurately estimate the probability of a climate crisis, right? So,
Yeah,
'cause
that's right.
you could say if he's investing in clean energy, for instance, then he's talking his book, right? But if he invests in some kind of disaster, right, protection, then he's not talking the book. So how do you actually design an investment strategy around what to be the
Well, I
trend?
think that,
Um,
Bob is an optimist and he's also a believer, very firm believer in efficient markets. He worked alongside Fisher Black, in the early days, his early days at Goldman. So he thinks that people are going to come to their senses
mhm.
and the reality, the underlying fundamentals are going to get priced into the assets. Uh, Maybe he's unsure exactly about the timing of that. So that's his bet on an efficient market. This risk is real. It's going to get priced in eventually. So he shorts oil, gas, fossil fuel uh, assets, and goes long things that can benefit from climate change. I forget exactly what that would be. I mean, solar stocks, I guess. Um, but yeah, a strategy, you know, it, it's it's a tricky one because you know clean energy was one of the best performing sectors in 2021. Um, did phenomenally well, but then 2022 was a little. I guess there was, it got a little bubbly. Um, you know, I think it's one of those things where it's more of a stock pickers I kind of hate to use that phrase, but the you really want to be an expert, and if you are, I think that you probably can do pretty well, because I think that ultimately Bob's right. The market is going to catch up. There's a lot of financial power coming from, the Biden administration's Inflation Reduction Act, other things, just the shift in the towards net zero policies from major corporations. That's just like a wave that's going to force lots and lots of money into this stuff. But picking the right one, like, would I want to be tell you what battery, EV battery company to, startup to invest in? No, because that, that's really, really hard. Picking winners and losers in this, whole, rush of startups to jump into this market is really hard. I mean, who would have seen Tesla, being worth $1 trillion in, 2015? So that's, a strategy is coming at it from a portfolio theory perspective with climate. It's got, I really hadn't thought about it, but it's pretty difficult.
Well, Scott, thanks so much for joining me. These books are all great. I was rereading Dark Pools and Quants just recently, and even though they're a decade old or so, they've aged quite well, because all three of these books, although they're about finance and risk and liquidity and other sorts of things, they're really about people. And you're telling stories about these players who kind of changed the financial landscape. And so keep up the good work. Look forward to the next book.
Yeah,
The book is called Chaos
that.
Kings, Dark Pools, and the Quants. Talk again soon.
Thanks a lot, Craig.
UnSILOed podcast is produced by University FM, elevating the stories of your institution.